Hi, I'm Victor. I'm an active value investor, and I like sharing my journey as an investor on YouTube. I've benefited greatly from watching other investors who share their analysis and their portfolios online, and I'm sharing mine as well. Today, I wanted to cover Zoom. Zoom is the big collaboration application, video conferencing application that is the #1 platform here in the United States and growing in Europe as well as in Asia. The company announced their earnings today. They've given me new information to update my analysis and then get to a conclusion whether I should buy, hold, or sell my shares in Zoom. I like to follow a process when I hold stocks and invest in stocks, and my process involves 4 questions followed by an action item. First, do I want to be a part of the industry that this stock is in? Is the company operated and performing well? Is debt less than 3 times EBITDA? And I want a discount on the stock. That way I can see my investment go up in value. Based on those questions, I then make a decision whether I should buy more shares, hold, or sell my position in Zoom. So it's good to see Zoom has a strategy to keep growing. And they're #1 in video conferencing, but they aim to grow outside of that one really specialization right now. And they're growing to be a more full contact center solution. And that involves collaboration to compete with the likes of Slack or Microsoft Teams, so taking some share away from those competitors, as well as full contact center applications. So if you're thinking about some service operation at a company that has 1,000 or if not 10,000 people that work on a call center application, Zoom wants to compete in that space. So it's good that they have a strategy to keep growing and broadening their applications and broadening their total addressable market. The company grew revenue if you compare the last 12 months closed compared to the previous 12 months, and they grew 4%. Now, if you look at their growth on a constant currency basis, it was 6%. So it's pretty good growth considering that Zoom just really grew so fast during COVID. And if they can continue to grow at a constant rate, like 4%, 4 to 10%, boy, this is a valuable company. Their enterprise revenue, meaning these are big customers that buy many, many seats for their employees, that's growing at 18%. I like seeing that because that type of customer brings in more revenue and is more profitable. You're only managing one account, but you have maybe 1,000 users of Zoom. And their churn rate is really low. It went down to 3.4%. Churn meaning that they're losing customers because they cancel the service. So their churn rate is under control. Zoom provided guidance, and for the fiscal year that begins on February 1st, they aim to grow about 1 to 2% this year. And that's good to see that they continue to grow. What's also going to grow is their profits. Their profits are really going to grow. They're going up almost, I would say about 60% in profitability. Great to see. Looking at their income statement, they grew nicely from about 4.1 billion to almost $4.4 billion in revenue. Again, they really just took off when the pandemic hit. Everybody needed Zoom to communicate, either to do their jobs, to go to school and so forth. And they're really maintaining that really nice high revenue. Their profitability was really nice on the gross profit line. It was less profitable because there was an accounting change on the way that they treat the stock that they offer employees or they give employees, and that really hit their cost. So that was the one-time effect. And next year, meaning the year that they're now in, profitability should be really good. Their balance sheet's in great shape. First off, they have $5.4 billion of cash or short-term marketable securities. So just a war chest of cash to acquire other businesses, to sustain the recession that we're just beginning. Just a really, really high amount of cash. And they have no debt. So that is great to see. No debt, lots of cash. The statement of cash flows looks good. Although the cash from operations went down about 300 million from year to year, it still left the most current fiscal year with almost $1.3 billion of cash from operations. CapEx is not a very big number at approximately 104 million. So it leaves almost $1.2 billion of free cash flow. I value companies based on the free cash flows they're going to produce in the future, and then discount those free cash flows to today's dollars. This is the free cash flow that Zoom produced, almost $1.2 billion of free cash flow in their most current fiscal year. Based on the growth rate of the cash flow, I'm expecting that they're going to grow years 2, 3, and 4 at 7%. And then long-term cash growth will be 4%. I'm discounting those cash flows by 8%. They've got a great balance sheet where they have zero debt and lots of cash. So very well capitalized business. So they deserve a nice low weighted average cost of capital. Based on those inputs, the company is worth $35 billion according to my model, but their market cap currently is $21.5 billion. So it leaves about a 52% discount on Zoom stock. Zoom was one of the companies that benefited greatly from the pandemic, and they really stepped up and provided the best video conferencing application for people to go to work online, for students to get taught, their classes. And a lot of people ended up using Zoom. So their valuation just in early 2020, it went from about $100 per share up to above $500 per share. So it went up 5 times in value just in a short period of time, which was incredible. Now their revenue was just dynamic. It went up from 2020, fiscal year 2020, it went up 6 times in just 3 years. So in 3 years, their growth in revenue went up 6 times. It went from being about a $600 million company to above a $4.3 billion company. So just awesome growth. But look at their stock price now. If you look at the stock price before the pandemic, they were about $100 a share, and now they're trading at about $80 a share. It's the same company. It just has 6 times as much revenue. So why is it that their valuation has dropped down to pre-pandemic levels? That's what led me to analyze Zoom and really begin to buy shares in the company, frankly, because I think there's a lot of value in this company that is unrecognized. This is the leader in the video conferencing space. Video conferencing is not going anywhere. I think we just use it every day now. It's part of our lives. And Zoom will continue to be the leader in that space, similar to a Netflix leader in the streaming business, or a Google search, #1 in Google search. Zoom is #1 in video conferencing. The performance of Zoom year over year, they grew by about 7%, which is very good growth considering that they grew so much in 2021 and 2022. Their market cap to sales, you're buying the company at 5 times sales, and they're profitable and they generate free cash. So I just think it's such a good value play. Their free cash flow, almost $1.2 billion. Their market cap is $21.5 billion. So they have about a 6% yield of cash. Balance sheet looks great, $5.4 billion of cash or marketable securities. Their market cap, that's about 25% of the market cap, and a forward PE ratio of 21. So really good, solid company. The revenue is expected to grow about 1 to 2% in their current fiscal year. They're going to be a very profitable company this coming year. So really good stuff. They are increasing their online customer prices. Those are consumer, customers that are just going on the website and buying individual licenses. So that should increase their revenues. I think there's good upside in the stock over the next 12 months. This is Zoom is the top video platform company around. It's preferred against all the others. I know they have a big competitor in Microsoft, but I don't think Microsoft's going to take over this space. I think they have their hands full with the 100 other things they do. Zoom really specializes in this space, and they'll continue to be the leader. They're going to grow the additional applications to round out the video conferencing application and give people like phone, you have the ability to buy another service that gives you access to a phone. Call centers can use more of their applications, and the whole collaboration that competes with Slack or Microsoft Teams. Zoom has the cash to acquire other businesses. So now that valuations are down, Zoom can acquire companies that can help them fill in that full suite that they want and continue to grow as a company. So looking at the scorecard for Zoom, this is an industry I want to be a part of. Video conferencing, especially the #1 video conferencing application, very good industry to be in. The company, #1 company in their space, no debt, so way below 3 times EBITDA, and a discount is available on the stock. Therefore, I'm continuing to buy additional shares. I have a medium to large position on Zoom, and I'll continue to make that position larger. Thank you for watching the video. I hope you found it interesting and discovered something new about Zoom. Keep in mind, I'm not recommending you buy any particular stock or bond. I'm sharing my investing journey, and in this case, I'm an investor in Zoom. Hope you found it interesting. Good luck investing in 2023.